Hello, welcome to another episode of the Legacy Investing Podcast. I'm Nate, and I'm joined, as I always am, every Tuesday by my good friend Josh. How you going, mate?
I'm very well, mate. And how are you?
Yeah, I'm doing okay. We'll battle through today. I'm feeling bit average, a bit sniffly, and a bit dry. So if I have a coughing fit, you'll take over.
Sure. So no third round of the vid.
No, definitely not. No. This is just a solid bit of hay fever, mate.
Yeah. Fair enough. All over it.
Yeah. Hey, we were recording on the 14th of June, and we've got some serious carnage going on in the share market at the moment on the ASX Australia, and obviously overnight in America. We've got some serious carnage, and we'll sort of do a bit of a round around the grounds of that. But this kind of all started last Friday in the US on the back of I guess worse than expected inflation numbers. It was higher than anticipated, and the share market didn't like that too much, and created it. Actually went down in the previous session. It was holding up okay, and then it just dropped off the face of the earth. So someone obviously maybe released the inflation numbers early, secretly somewhere, but and then across the weekend we had a huge crypto crash. Again over the weekend.
Again. So
again.
They lovers.
And then obviously Australia here. Yesterday we had the public holiday, and so the ASX wasn't open. So we've got this big double whammy going on today of lots of bad news, and then this is the first day of the ASX been opening, and it's down. What's it down now, mate? Let's just check this. It's down almost
4.1%.
4.1. So it's come back a little bit.
Yeah, it's probably changed. Probably changed from 10 minutes ago. I wrote it down. So
yeah, 4.3% is the ASX 200. So that is a huge drop. I don't know if I've seen that even in COVID levels. I can't remember what the biggest drop was in COVID.
I don't know. I'm expecting that to be the biggest drop in history, probably.
History? You're calling it?
I don't know. We're going to call it
some research.
I should, but I don't. So you talked me into doing a episode today on some news, on Around the Grounds news. So let's do it.
So yeah, I mean that was a quick sort of rundown of the last 3 days, and yeah, it's looking like the ASX is going to have a pretty miserable day. It really just dropped at the open, and it hasn't really changed too much from that 4.5%. So not a lot of good news. I guess a lot of inflation concerns are really starting to heat up now. People were hoping, I think, that the inflation theme was easing off, but it doesn't look like it is. We've got obviously the Ukraine war it doesn't seem like it's going to end anytime soon. We've got major supply shortages, which doesn't seem like it's going to end soon. It looks like China is having a bit of a flare up of COVID, and looking like more lockdowns are on the cards in not only in Shanghai but Beijing too, which is definitely not good for supply chains, and it's really just all
perfect storm, mate.
Perfect storm. It's a bloodbath.
It is, and I think all these things, we've talked about it a number of times. I'm happy to call it. We're in for a market crash. We really are.
Big crash.
I'm not going to say we're already in for it, because we've already been dealing with it. So I think it's fairly here. Yeah.
Well, I mean, the first 6 months of this year, year to date, is the worst decline we've had to start the year since 1940.
There you go.
So there you go.
And on that bit of juicy information, I reckon, as we talked about before, we'll go through a couple of different companies, so a couple of indexes, a couple of markets, and talk about their daily drops and their year-to-date drops, and it's not what you usually see, especially in the last 10 years of stock market news or stock market, I guess, performance. This is very contrary to what everyone believed could ever happen.
Yeah, I mean, it's been relatively bullish since the GFC, with occasional we had a bit of a mining crash in 2015 or 16, I think, and then obviously 2018 there was the Greek crisis. And so, but all those, and obviously COVID, everything's bounced back pretty quickly. So, this is like you said, 6 months of declines here. Probably the first time since GFC we've had a really, really bearish trend developing, I think.
Yeah, and I also think it's important. I listened to a really good podcast, one of the Property Couch podcasts a couple of weeks ago. It might have been one of the later ones. And they had what's his name? Scott, Motley Fool dude. Scott.
Scott. We've forgotten his name.
Yeah, sorry. Anyway, he was on
Scott Phillips.
Scott Phillips, yeah. And
sorry, Scott.
Yeah. Thanks for listening, Scott. We appreciate it. No, he nailed it on the head. Like, and he's very much like a dollar cost average. He talks about that a lot, just like Warren Buffett talks about it. You know, if you're not putting in the if you're not willing to put in the time and effort that it takes to really understand a company, then buy the index and back your country essentially. And even he said, like, when all this is happening, he was saying, you know, practice what I preach. It just means I get to buy more shares when it's lower. And even right now, you know, some of these indexes, you know, are off quite a bit. You're just getting more shares for your money. And every peak and crash has been followed by a higher peak. So it may take 1 year, it may take 10 years, it may take 18 years as it has in the past. But, you know, we invest for long-term gains. So
I will say this, mate, and this is definitely not financial advice, but I have a bit of a comical messenger chat group. We talk shares all day long, and with a bit of work, a bit of work in between. And and one of the guys said today, "Oh, is it, you know, what's on bargain? What are we buying today?" And I'm like, "Well, there's plenty on bargain, but it's whether you think it's you know, going to bounce back from here, or is it going to go, you know, what's the positive news that's going to turn this around?" And I will say there's not a lot of positive news. Like, I think inflation is here to stay for a little bit. And so I will say that, you know, it's a great, obviously, on sale day here in the markets here in Australia and across the US the night before. But you certainly wouldn't want to be putting all your cash in at this point. It just seems a little bit too far too volatile. I don't see us. I don't see this being the bottom, my own opinion. But you certainly wouldn't want to be putting your own cash. And you just mentioned it, dollar cost averaging. If you are, or if you do feel like this is getting close to some good prices here, but we've got our watch list, and you're going to go through a few little companies here now, year to date, and sort of the falls overnight. Just because I think it's a bit historical in terms of the period of time and just the huge drop. So, mate, take us away.
Yeah, well, I guess we've got a few more American companies than we do Australian. So we'll start with Bitcoin. How's about that? Because we know how much we love Bitcoin, right? It's actually, if you look at the last 24 hours, it's performed better than any other company that we put on this list. But don't look at the last 3 days. Hey, Bitcoin last 24 hours for Bitcoin at 3 p.m. ish, 0.66%, so nothing. But it is also down at like $21,000 US, so it's dropped heavily.
20% on the weekend, on the day before, I believe. Yeah,
it's ridiculous. But you look at year to date, and it's down 53%. So
I thought it was more than that. That's surprising.
Well, yeah, because remember, it did get up to 60K US.
Back in November, December, it really dropped from 69. Down
so
to
if you change that year to date to maybe 8 months, it's going to be heftier, a lot heftier.
It's like almost 80%. Yep.
Yeah, but let's have a look at a few Australian companies, ones that we've talked about in the past. Just a few. Fortescue Metals, I'm a fan. 8.9% down 8.9% when I looked at it today, which was less than 15 minutes ago. However, probably better than most of them. It's only down 1.6% over the year to date.
Okay.
And that is because, as we know, late last year, they were
that big spike.
Yeah, they were at $14 a share. So they're currently sitting at around $19 a share, $20 a share. But yeah, they've come off nearly 10% today.
Yeah. It's really gone sideways since January, since the hydrogen update. Yeah.
Yeah, they had a really big bull run over about a period of a month, which was really nice to see. Codan, one we've talked about quite a bit.
Codan?
Yeah, they're down 4.6% today and 30% year to date. So that's, I wouldn't call them a tech stock, but they kind of follow what happens with the tech stocks a little bit, don't they?
Yeah, well, we've talked plenty about Codan, but they have been hammered. Yeah, even if we go even further than year to date, that they were at $20 and they're at 670 at the moment. So they've been absolutely hammered.
Yeah. And yeah, I love talking about Codan because that's one I was looking at. I remember when I was living in the Northern Territory and I was really getting into this stuff, and I looked at Codan and I'm like, oh, it was $2 like a couple of months ago.
Yeah.
And then I'm like, now it's like $5. I probably shouldn't buy it. It's already had its run. Then it went all the way up to $20, and I'm like, that's a stupid emotional thing that you let yourself to fall into. But yeah, let's move on to A2 Milk, the ex-darling of the ASX.
ASX, yeah.
Down today 7.5%, and year to date 25%. And then let's not even talk about from its peak.
No.
Is that 20 something dollars all the way down to 4?
Yeah, gee.
But the ASX itself, looking at the ASX 200 today, when I looked at it, it was 4.14%, and year to date down 12.5%. So
we've actually done not too bad compared to America, and I think that's probably the commodities that have pulled it up. You mentioned Fortescue and BHP and all the big guys, plus all the the lithium was sort of crazy hot there. So I mean that surprised me. 12.5%. Is that all it's down this year?
Yeah, for sure. But what I will say about that is I think usually US markets, like US market, US indexes and so forth, sure they've come off a lot more, but I'm sure that they ran a lot harder as well. So you get a lot more volatility, a lot more investors, a lot more activity happening over there. And we've seen that through, when we do our weekly calls and we're looking at options. The sheer amount of options volume in the US is crazy compared to the little options volume in Australia. Unless you're trading a really big company, you struggle to actually fulfill any contracts. So I thought that'd be the few companies we look at from Australia. A few more in America that we've especially been paying close attention to over the last couple of weeks. Obviously, there's a fair few tech, actually, pretty much all tech stocks.
Yep. Okay.
we should look at some other companies.
Well, the reason it makes up, those 4 or 5 tech shares make up a good portion of the index at the moment. So that's why they do get talked about a lot, and they ran the hardest post-COVID, and just on that, you're talking about America running really hard. More so than Australia. I mean, the NASDAQ is not even 50% of the way down from. At COVID, it was around 7.5, and peaked out at about 16, and we're at 11. So it hasn't. You're right. The American stocks ran really, really hard and had a far bigger jump from COVID low to post COVID high, and but they still aren't even back to pre-COVID high levels.
Yeah.
We could go a lot further maybe, but
yeah, well, like we've discussed, you said it's your opinion, it's my opinion as well, and it's only an opinion because I'm never right. But I really see this going a lot deeper. I don't think this is anywhere near what we're about to see. It's a perfect storm, isn't it? It's like there's so much negativity happening in the economy, in the full global economy, and I just cannot see this thing bouncing back with high inflation, interest rates starting to really charge. Like, it's not often you see massive 0.5% moves. America's talking about 0.75% move kind of thing. Like, that's scaring people a bit, especially people with mortgages. But that's all happening. You got the war. It's not really an ideal environment right now. And the more this happens, even though cash is still crap, cash or bonds may become more interesting in the future. I don't think it's going to move that far, but I really think that the markets aren't going to really like what's happening. So, and like we talked about a couple of weeks ago, what is it? The American GDP compared to the share price.
Yeah.
The Wilshire GDP ratio.
Yeah.
Still
Yeah.
over 200, man.
Yeah.
That's
Yeah.
crazy. So,
Yeah, it's really high.
but yeah, you want to have a look at a few American companies? Talk about
Let's do it,
this?
mate. So, hit up Netflix. Let's do Netflix first because that's best in breed, I guess, of the streaming, in our opinion, is of the streaming companies. And they've all been hammered. Disney's been hammered and so forth. But what's Netflix year to date? Or what was it last night?
Yeah. All right. Well, it's pretty good because year to date it's nearly 10 times bigger than last night. So 7.25% last night. That's a big drop. And on top of that, year to date, 71.6%. That's
21. Yeah.
just a little drop, eh? Because we know that was what $600-700 a share at one stage. Now it's worth about 164. So
$700. Big that.
Yeah, that's nuts, eh? And while we're at it, we may as well look at your big five. I think we got them all here anyway. Google last night dropped 4.29%, and year to date it's down 26.6. So
okay, 26%. Yeah, all right.
Big moves. Facebook, another one we've been talking quite a bit about recently. Down 6.44 last night and 51.5% year to date.
It's halved. Okay.
Halved. And we, whenever we do the old Data Roma episodes and look at what the gurus are buying, Facebook's always on today.
Has been on the list, yeah.
Yeah. So with all these big drops, like who knows where it's going to be in 10 years, eh? Alibaba had a massive run recently. It went from like 90 in the 80s. Yeah, it was down, high 80s, ran up to what 115, 120.
Yeah, it got pretty high there.
Yeah, clawed back a little bit, so I think it's just under 100 now. Dropped 10% last night and 18% year to date. So that goes to show, the kind of negative run it's had prior to the start of the year as well.
Yeah, and again, it's one of those stocks. If we go back to the back end of last year, it's far more than that 18%. It was up around $320 a share, and it's down at $98 at the moment. So yeah,
for sure. And this is one that's sure it's had some pretty big negative days, but this one's been coming off the heat for like over a year now. Peaking at over $300 a share. So this is more in line with what a bearish kind of thing would be. It's a slow burner, but it's continually negative. So, we move on. Apple. Apple's pretty cheap compared to what it has been, in the previous. But 3.8% last night, so not as bad as most. It's probably done better than everything else on the list here, and 27.5% year to date.
So Google and Apple have, I guess, held up reasonably well. I'm interested to hear Amazon. I'll let you go to Amazon and then I'll have a chat.
Yeah, well, Amazon hasn't held up as well. 5.4% last night, but nearly 40% year to date.
Yeah, okay.
But I think the one thing to mention with Amazon too is like their PE ratio is still over 50.
Yes, it's the highest PE of those big five, I think.
Yeah, I haven't looked at it, but the other ones, but I would say, yeah, for sure, it has to be. Like
maybe
we know Facebook and Netflix are down at 15.
Yeah,
that's actually a really good price to earnings ratio for tech company.
Yeah, Google's at 19, and Microsoft also is reasonably. I'll just quickly get up Microsoft. Microsoft's 25, so it's the second highest PE of those five stocks that we've just talked about.
Yeah. So that's interesting to note.
It's 15.
I haven't got Microsoft
for a growth share. That's yeah.
So
15.
have you got Microsoft in front of you? Because I haven't got them on this list.
Yeah. So let me just get it up again. Microsoft was down 4.2% overnight, and it's come down from a high of 350, and it's sitting at, what are we at the moment? 242. So yeah. What's that?
Are you on Google? You just press little year to date.
No, I'm not on Google.
Oh, get rid of that, Microsoft down 4.24% last night and down 27.6% year to date.
Okay, 27. So it's another one that's sort of sitting in that. Yeah.
Yeah. But here's another one we've been talking about a little bit recently, PayPal. Big drops. 7% last night and 62% year to date.
Yeah.
So well over half.
So I mean, these PEs for the last probably 4 or 5 years have all been sort of upwards of 50, 30, 40, 50, and they've all just really halved recently. And it's still, some of them are still expensive. You mentioned Netflix before; it's down to a 15 for a growth share. That's the historical average of the American share market.
Shiller PE ratio adjusted for inflation's been 15 long term. That's still quite high, I'm pretty sure. So we'll see how that all fares. But even Ray Dalio, like I remember reading a few articles. I think I've mentioned this a few times. And once again, if you don't follow Ray, follow him because he's very good at what he does.
Yeah.
But yeah, he was even saying, I think it was 2020 or I think it was in 2020 maybe. He was like doing his like around the grounds kind of thing, but he wasn't looking at total market. He was looking at industries. And he said, a lot of them were given the cash rate, not too badly priced, but he did say, especially emerging tech and especially tech were in big bubbles. And I think he called it a couple of months ago now that basically the tech bubble has popped. And you got to agree with that. Like Nasdaq's down 4.7% last night, 31% year to date for an index, 31%. So it's pretty big.
31%.
Yeah. But
so I've got a chart up. It says it still actually hasn't bottomed out in terms of it's pre-COVID high. It's still not back to its pre-COVID high. So it shows you how hard it's run.
Yeah.
But so 50%. So you said it's 30%.
30% year to date.
Mm.
So yeah, it's come off pretty hard. Hey. Yeah, looking at the 5 year. Yeah, wow, that's crazy. Hey, so it's pre-COVID high to now. It's still up 18%.
Yeah.
No, sorry, it's still up 11%. So where does it go to? Because even when a lot of the big guys called it, even when the COVID crash happened, they even called it then and said, that wasn't the crash.
No, yeah, you're right. Yeah.
Yeah. So I follow Phil Town pretty closely. And even we know Warren Buffett didn't buy during that period. He sold, he was a net seller.
Yeah.
Sorry if you hear vibrating. That is I'm guessing a helicopter flying over.
You're on base, mate.
I'm at home. So sorry everybody about that. Yep, there it goes. So yeah, I think we're calling it. I think we're in the crash. Yeah, I think we are anyway. I think this has got plenty to go.
Certainly it's showing all the elements of, we've had some pretty significant down days, followed by these little bear market rallies, people will call them, and followed by some more bad information. It drops even further. And, I listened to a couple of technical investors recently, and they were talking about these bear market rallies have been on really low volume compared to these drops of quite heavy selling. So
yeah. That's reminded me of something. So talking Ray Dalio again, Principles for Navigating Big Debt Crises. It's a free book you can get online. Highly recommend having a read of that because there are parts in that book. So you can just download it as a PDF and read it on your tablet or your phone or your laptop. I haven't finished it, but going through that, he talks a lot about how economies work. And how our economy at the moment just don't have all the levers to pull to really get this thing out, which is why, coming from a zero cash rate and then having this inflation, very, very kind of hard to balance stuff. But he does have in the book these parts where it talks about the Great Depression and 2008 and the news articles, and he basically goes through like what the news articles are giving, like saying, and what's actually happening. And the roller coaster, man. Like I feel like you lose 20 years of your life if you follow the news doing this stuff, because it's like, you know, days like this will happen, and it's this big negative day and everything's red, and everyone's just like, oh, we're having a, you know, world war crisis, blah, 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 blah. And then tomorrow there'll be like a 1% or a 0.5% green. And then it's like, oh, everything's good again. Everything's good. Like we're out of it. With the market crash is finished. And then 2 days later, it'll be another negative thing. And they're like, oh, everything bad's happening again. It's so funny because you can actually look back at what was happening while it was happening. And just the sheer, like, one day everything's roses, the next day everything's, you know, knife edge falling. And that happens for like a year. And that goes on for like a year. Like, could you imagine the anxiety you would induce into yourself following that? Getting back to, I guess, what we're talking about. That's why I'm feeling anxious talking about it. No, it's really interesting because you can see what is getting said, what is happening. You know, net red days, very much net red days. But as soon as there's a green day, you know, everyone's jumping on. Essentially, I don't care about that. And as you know, and I'm pretty sure I've made it pretty clear in this, I hate the news, and I do not follow this crap at all because it is anxiety driving. So like we invest, it's always the same way. Just we've got our lists ready, and this is why we've been putting the work in. Moving forward, we're just waiting for our companies to come on sale. Some of them are on sale, and you're just buying. And the more they go down, you know, have a plan. I think that's one thing I could really try and drive home as well, is have your companies know what you want to buy for, but have a plan, because at the end of the day, if your company comes on sale and it drops some more, then do you still have capital to buy more? Maybe set up for purchases. You know, if it drops another 10%, you buy another 25% of your purchase volume. If it drops another 10%, you know, and then if it punches up, just get in before you lose your price, kind of thing. Like, you know, but at the end of the day, so much emotion goes into that. If you can buy under your buy price, just be happy. Yeah. Because you've got into your company. If it goes down 30% more, then you know what? You've done your research. You're comfortable that it's going to grow. Yeah.
And you know, I mean, you know, you buy a price because you understood the company, you've done your research prior. So it's good to again, not advice, but I think nibble away, like you just said. You certainly wouldn't load up straight away. You got no room to wiggle then. But certainly, thanks for that, mate. Thanks for all that info. Certainly interesting to look ahead. I think we've got the Fed in America coming out, and they will announce what the next interest rate rise is. And I think it's now post sort of the last few days. I think it's now assumed it might be a 0.75 increase. I think originally it was thought to be 0.5. And probably the only way this turns around here is if the Fed starts to get a bit dovish, and sort of starts to change their tune a little bit. But yeah. Maybe we might call it a day there, hey?
I think so. That sounds good. I think we covered a lot of good information, and you need to get home and get to bed.
Yeah, I'm going to leave my worst. Well, yeah, thanks to everyone for listening to another episode of the Legacy Investing Podcast. We'll be back again next week.
Thanks, mate. Have a good one. Bye.